Good morning, everyone, to this webinar jointly organized by the International Energy Agency, the Italian Institute for International Affairs, IEA, and the SIP, the Center for International Energy Policy. I'm here today in my capacity as the scientific advisor of IEA, and I am together with Kobe van der Linde, Senior Fellow at SIP, and Gergely Molnar, Gas Analyst at the IEA. As per tradition, we will have a webinar on the gas quarterly report by the IEA that we will present it by Gergely Molnar, and then the Q&A session will be moderated by Kobe van der Linde. You will have a chance to ask your question. You can already post it in the dedicated Q&A box. Many interesting things in gas markets. As always, prices have further increased. Of course, we are far from the prices of 2022, but still we see quite high prices, and Gergely will tell us more about it. Just a couple of comments on my end about the main markets. In Asia, we see sustained growth. As I've had the chance to read in the executive summary of the report, we see double-digit growth, especially in some countries. Demand in Asia seems to be driven by industry and in terms of countries by China and India. There's strong GDP growth in Asia. We have seen it with the forecast of this year. And actually, even if we look at the medium to long term, there is sustained GDP growth in those countries, which is not the case in Europe. There are other drivers for a somewhat bright outlook for gas demand, also in the medium term. The coal to gas switching dynamics in the Asian power sector, preference for gas in petrochemicals, and policies promoting city gas development. But Gergely will tell us more, and we'll put also some numbers behind Asian gas demand dynamics. In Europe, we are awaiting key policies, key legislation on gas that will impact demand. There has been, of course, the adoption of many legislative acts with Fit for 55, but the implementation is only starting now. So there will be a lot of reviews foreseen for some key legislation impacting gas. There will be delegated acts that will impact the role of gas, for example, in the heating sector with the definition of the hybrid heating systems, with the methane regulation that obliges importers of gas in Europe to verify the methane content of the gas that they import in coordination with the exporting countries, but the methodologies still need to be set. Countries are submitting in this week their national energy and climate plans to the European Commission, and this contains measures that will be key determining how much space gas will have in the European energy mix. A recent piece of news is that the outlook for hydrogen in Europe is somewhat cloudy, especially after the European Court of Auditors has published a report in which it says what many already knew or suspected, that hydrogen targets, the very ambitious ones set by REPowerEU, 10 million tons of domestically produced hydrogen and 10 million tons of imported renewable hydrogen by 2030, are very difficult to attain. Russian gas in the European energy mix has come down a lot, from 45% before the crisis to 15%. Europe was very fast in cutting its dependency on Russian gas, but for a long time now, the share of Russian gas in the European mix has actually been stable. One of the elements that featured in Ursula von der Leyen's address to Parliament yesterday, before she was re-elected, is that Europe confirms its determination in getting rid of Russian fossil fuels, which is the mandate of the Repower EU vision. So it will be interesting to see in the months ahead what will happen to Russian gas imports in Europe, especially in light of the expiry of the transit contract through Ukraine. In the meantime, relative to the last time in which we've seen each other with the European Gas Quarterly Report, Europe has adopted its 14th package of sanctions against Russia, which for the first time feature measures on LNG. The package does not prohibit import of Russian LNG into EU terminals, except very small numbers of non-interconnected terminals. But it prohibits reloading services in the EU with a derogation in case the reloaded volumes go to other EU terminals. So one of the key elements, I believe, to look at in future is the impact of these measures on Russian energy exports, because Russia was using European terminals to reload volumes to Asia. These are just some elements, but let's hear more from our expert, Gergely Molnar. So I'd like to give him the floor. And as I said at the beginning, please do not hesitate to already post your questions in the dedicated Q&A box, even while Gergely is speaking. Gergely, the floor is yours.
Thank you, Luca, and good morning, colleagues. Delighted to be here at our traditional gas webinar. As you might know, just in the beginning of this week, we published our quarterly gas report, which is, of course, available free of charge on our website, iea.org. The report itself looks back to the gas market dynamics in the first half of 24 and also gives a short-term forecast for the full year and a special outlook, a medium-term outlook on low-emission gases until 2027. And our presentation will be very much structured along the same lines. So first, we would like to have a look on the global gas market trends and what is happening across the key regions. And first of all, I think it is important to note that we have seen that natural gas prices strengthened across all key gas markets. In Europe, TTF was up by 15% on the quarter, so compared to Q1. And as we can see on the first chart, towards the very end of Q2, gas prices have been already close to the core switching price indicator, which means that the most efficient coal-fired power plants were becoming, in a way, competitive against gas-based generation. In Asia, JKM prices followed a similar trajectory, and they increased by about 20% on the quarter. And we also see that they entered in the oil indexed price range, so meaning that that oil indexed energy contracts were becoming increasingly competitive against spot energy prices. And last but not least, if we look at the North American market, we see that Henry Hub prices have collapsed to decade lows in February, March, to a low of $1.50 per MMBTU. But then they recovered by around 70% to $2.50 per MMBTU in June. And this has been due to a combination of production cuts by US upstreamers and also quite a strong gas demand growth coming from the power sector. As we speak, Henry Hub prices are now again falling, and they have been trading in recent days close to $2 per MMBTU, so below actually the break-even cost of many US producers. Now, and what has been driving this strengthening of gas markets? We believe that this has been very much supported by tighter supply fundamentals. And on this slide, we are showing the key channels of global gas trade, namely Russian pipe gas to Europe, pipeline imports to China, and global energy supply. And what is quite interesting to see is that in the second quarter of 2024, if we look at the light blue bar, we see that global energy supply actually contracted compared to the same period of last year, which is the first time we see a year-on-year decline in energy supply since COVID. Of course, during COVID, it has been very much driven by demand dynamics. This time, it is due to issues on the supply side. And if we look at this slide, we give a bit of a deep dive on the supply dynamics surrounding energy production. We see that the main driver behind this decline has been feed gas availability issues at legacy producers, namely in Egypt, where energy output dropped by over 80% year-on-year. And this is partly because of plummeting upstream production and also strong domestic demand growth. And actually, as we speak, Egypt is turning to an importer of LNG with a new FSRU installed in the country. And also discussions are now happening in Egypt that potentially some of its LNG export plants could be reconverted into LNG import facilities. We have also seen that in Nigeria, feed gas supply has been impacted by the security issues in the country, and also in Trinidad and Tobago, LNG output dropped by around 15% year-on-year. And this is because the declining production rates of aging fields. On the top of that, we had unplanned outages occurring in the United States, in Australia, and this, of course, further reduced the availability of energy supply. Now, when we are looking at this map, we also see that there is a number of new projects which are expected to come to the market in the second half of the year. Many of them located in the United States. This includes Freeport LNG, where in the second half of the year we expect that the plant will operate at a new capacity, at an expanded capacity. Also, Plaquemines LNG Phase 1 is set to start producing the first drops of LNG in the coming days, weeks. And also Altamira FLNG, which is located in Mexico but relies on US-sourced gas, is expected to ship its first cargo of LNG in the coming weeks. And last but not least, Corpus Christi Stage 3 expansion is expected to start operations towards the end of the year. And also in Africa, Congo FLNG started operations already in Q1 and ramping up production levels, and Tortue FLNG is expected to start up operations towards the end of the year. So altogether, we expect that global energy supply will increase by 3% or 15 BCM in 2024. And this is very much driven by higher output from North America, as well as from Russia. And this is not because we expect Russian energy coming from the Arctic 2 energy plant, but because Russian energy plants were facing quite a heavy maintenance in 2023, and we don't expect this to reoccur in 2024. So in a way, we expect more energy coming from the Yamal LNG and the Sakhalin 2 energy plants. And last but not least, in Indonesia, the Tangguh LNG Train 3 is also ramping up and providing additional energy supplies to mainly to Asian buyers. Now, from a demand perspective, we see that after the gas supply shock of 2022 and the gradual rebalancing in 2023, global gas demand returned to a rather strong growth in the first half of 2024. Our estimates indicate that global gas demand increased by around 3% compared to 2023. And about 70% of this growth has been actually concentrated in the first quarter of the year. And of course, to put this into perspective, 3% is well above the historic average growth rate of 2%. So we see that gas demand is returning to a clear growth pattern. And if we look at to this picture in a bit more closer, we also see that what is driving this growth. From a regional perspective, we have seen very, very strong growth happening in the Asian markets, with both China and India returning to double-digit growth rates. And for the entire Asian region, our estimates indicate that here gas demand increased by around 8%. We also saw growth in North America, about 2%, which was mainly driven by higher gas burn in the power sector. In Eurasia, gas consumption increased by around 5%, and this was partly due to colder weather conditions, but also higher gas use in industry. And we will talk about this in more detail. In contrast with other markets in Europe, we continue to see natural gas declining, mainly due to lower gas burn in the power sector. And when we look at Central and South America, we see that natural gas consumption increased by around 3%, and this has been partly due to a lower hydro availability in certain markets, such as Colombia, but also stronger gas use in industrial sectors. Altogether, in the first half of 2024, Asia accounted for about 60% of incremental gas demand, and industry for about 65%. Now, looking in our forecast for the full year of 2024, we expect that global gas demand will increase by around 2.5%, or just above 100 BCM. And as we can see on this chart, this will be very much driven by industry as well as energy own use. Industry alone is expected to account for about 45% of demand growth in 2024. And from a regional perspective, very much in line with the dynamics we have seen in the first half of the year, it is Asia which is driving demand growth, accounting for more than 40% of incremental gas demand. Again, very much supported by China, India, and to a lesser extent, emerging Asian markets. In the gas-rich markets of Eurasia, Africa, and the Middle East, we expect natural gas consumption to increase by around 3% compared to 2023. And this is partly driven by higher gas use in the power sector, but also stronger demand coming from the gas-intensive industries. In North America, we expect gas consumption to increase by around 1%, and this is mainly driven by stronger gas use in the power sector. We see that's happening across all markets of that region, in the US, Canada, Mexico. I think in Alberta, just a few days ago, gas-fired power generation reached an all-time high record due to a combination of strong electricity demand and the continued phase out of coal-based generation. In contrast with all the other markets in Europe, we see that natural gas consumption is expected to stay close to last year levels at best, but there is also some downside risks to that. And as we can see on this chart, the key driver behind that is that gas-fired power generation is practically collapsing in Europe. And this really gives us a bit of chance to look closer to what is happening in the European market. On the first graph, we are showing here the demand evolution in the first half of 2024. We estimate that natural gas consumption declined by 3.5% in the first half of the year, and this has been primarily driven by lower gas burn in the power sector, which declined by around 18% due to the strong expansion of renewables, which has been also complemented by a very good hydro year, especially in the southern markets of Europe. And in addition, we had also quite mild winter weather, and also we see that some of the gas-saving measures which had been implemented in the previous winter seasons, they are persisting. In contrast, we see some recovery happening in the industrial sectors. We estimate that industrial gas demand increased by around 10% year-on-year in the first half of 2024, but it remains also 10% below the pre-crisis levels. Most of that recovery is happening in refinery and in gas-intensive industrial sectors, such as fertilizers, and also, of course, it is a rather fragile recovery, very much dependent on the evolution of gas prices. From a supply perspective, I think it is interesting to observe that after the very strong growth in energy imports in 2022, Europe in the first half of 2024 decreased its energy imports by almost 20%. And this has been due to a combination of relatively weak demand, high storage levels, and also, as we can see on this chart, stronger piped gas deliveries coming from Norway, but also from Russia. One additional point to note is that we continue to see European natural gas production to decline by around 6 to 7% in the first half of 2024. And this is driven mainly by two countries, the Netherlands and the United Kingdom. I think it is also fair to note that we expect that the European upstream will perform in a slightly better way in the second half of the year, partly because the Tyra field in Denmark will be ramping up, and also the Sakarya gas field in Turkey is also ramping up production. Looking at the European storage trajectories, in the first half of the year, or more precisely in the second quarter of 2024, we have seen that storage injections were slower compared to 2023. Approximately 30% less natural gas was injected into underground storage facilities in the second quarter compared to their 5-year average. But at the same time, thanks to the high initial opening stocks in April, the EU is very much on track to reach its 90% fill target by the 24-25 heating season. So we are quite confident that these targets will be reached and even above that. And this is partly because we see a rather weak demand, and also the initial opening stocks are helping. Now, what does this mean for the summer balance? We essentially see that Europe will need less energy. It will continue to need less energy over the remainder of the summer season. We expect that the EU plus UK energy imports could further decline by around 15% year on year, simply because there is less storage injection needs and consumption remains rather weak. Meanwhile, we see more healthy pipe gas supplies, mainly due to less maintenance in Norway. But of course, this picture can be easily distorted by the forces of geopolitics. This map is just a recollection of some of the incidents where geopolitics interfered with the well-functioning of gas markets. One of the major and key uncertainty ahead of the upcoming winter season is the expiry of the Russian-Ukrainian interconnector and transit contracts. This is an issue we are closely looking at, and this is certainly an issue we will closely address in the upcoming Global Gas Security Review, which will be published in October of this year, ahead of the heating season. Now, the report is also complemented by a medium-term outlook on low-emission gases. At the International Energy Agency, we launched a low-emission gases work program almost 2 years ago, and since then we tried to track closely market developments related to biomethane, low-emission hydrogen, as well as e-methane. And we expect quite robust growth in that pace. We expect that low-emission gases will more than double by 2027, adding approximately 15 to 16 BCM equivalents. And this growth is very much driven by stronger biomethane output, as well as the ramp up of low-emission hydrogen production. Now, despite this strong growth which is expected, it is also very clear that further efforts are required to reach the ambitious targets set by governments. If you look at the biomethane picture, I think it is just fair to say that in the last 10 years, we have seen a very robust growth in the scale up of biomethane. It increased by almost sevenfold between 2012 and 2022, and we continued that this expansion has been also present in 2023, when biomethane output increased by around 15%. Now, most of that growth has been driven by Europe and North America. And when we are looking at a medium-term outlook, we expect that biomethane output will double from around 8 BCM in 2023 to between 15 to 16 BCM by 2027. And about 80% of this growth will be concentrated in Europe and North America. In Europe, we see that growth is increasingly coming from France, which is expected to become Europe's largest biomethane producer by 2025, ahead of Germany and Denmark. But we also expect quite some growth from Italy, as well as the Netherlands. In North America, the key driver is the United States, and here growth is supported by more stringent fuel requirements, including under the renewable fuel standard regulation. And so the key driver sector also in the United States is expected to be the transport sector. And altogether, we expect that US biomethane production will increase by around 90% during this period. In addition, we also see growth coming from emerging producers, including Brazil, China, and India. Although in those markets, biomethane is still very much nascent industry, and as such, we at the International Energy Agency are also engaged to facilitate the sharing of best practices among more mature producers and emerging biomethane producers. Looking at low emission hydrogen, the picture is also very exciting. Let's put it that way. If you look at all the projects which have been proposed, planned, we see a very strong growth potential with global low emission hydrogen could potentially reach 16 million tons per year by 2027, which would then translate to over 50 BCM equivalent. But when we look at closer, we see that only 20% of those projects are in a mature phase of development. So either they are under construction or have reached final investment decision. So altogether, we expect that by 2027, just around 3 million ton of low emission hydrogen production would be available for the market, and about 85% of that growth would come from North America, China, and Europe. We also see quite some potential in the Middle East, namely in countries such as Oman. Last but not least, e-methane. E-methane is produced from low emission hydrogen by adding to it a carbon source. Japan has a target that by 2030, 1% of the gas in city gas would come from e-methane. And if we look at all the projects which have been which are being in some stages of development, we see that global e-methane production could reach 1 BCM by 2030. But of course, the development of these projects is still very much dependent on successfully reaching a final investment decision by the partners in the coming years. What we see is that e-methane ambitions, they are still lagging behind, and as such there is a need for closer dialogue between producers and consumers to see how these investments can be effectively de-risked. And with that, I would like to move to the key takeaways of the report. First, global gas demand returned clearly to stronger growth, with our first data suggesting that it increased by 3%, which is well above the 2% historic average. And of course, this growth is very much driven by the Asian markets, especially China and India, which both displayed double-digit growth rates in the first half of 2024. Second, we see that natural gas prices have been recording strong gains in the second quarter of 2024, and this is mainly due to tighter market fundamentals, but also geopolitical uncertainties, partly related to the future availability of Russian gas in Europe. When looking at the global energy market, we see that growth is still below historic averages. We expect that this year global energy supply will increase by just 3% or 15 BCM, and most of that growth is actually expected to come to the market in the second half of the year, and very much supported by North America, Indonesia, and some African new producers. Looking at the European market, we see that there is not much recovery happening in terms of natural gas demand, and we're also quite confident that despite the lower energy imports, the European Union will reach its 90% fuel target or even above ahead of the 2024-25 heating season. And last but not least, low emission gases are expected to more than double in the medium term, but it is also very clear that further efforts are required to reach the ambitious targets set by governments. I would like to thank you for your attention and looking forward to your comment questions. Thank you.
Thank you very much, Luca and Gergely, for both the introduction and for the presentation. I hope you keep us abreast of all the developments also in the next presentation, because I think it's really important to see what is going on and what everyone is doing. I want to give you the last word, Gergely. If there's something that we haven't covered or you want us to think about when we're moving towards the next reporting done by the International Energy Agency, then please be my guest. But if you said it all for this moment, then I want to thank you and Luca for the introduction and the presentation to enlighten us on the latest developments.
Yeah, no, Kobi, maybe just to thank you, Luca, our colleague Natalie, for hosting this webinar today, and also for all the colleagues who joined today and who were interacting with us and keeping a rather lively discussion, and also wishing you all a very good summer season. And we will be back in October when the European heating season starts, and of course that's the most interesting part for the gas year.
Thank you very much, and likewise on everyone's summer. Thank you very much, and goodbye.
Thank you. Bye-bye.